JD.com is a major Chinese e-commerce player, but it's not an Alibaba-style marketplace. Instead, JD bets on controlling the supply chain to deliver fast and build trust, especially in categories where service and authenticity really matter. At the simplest level, JD runs a hybrid engine. One side is first-party retail. JD buys inventory, holds it, and sells directly to consumers. The other side is a marketplace where third-party merchants sell on JD and pay platform fees and marketing services. That mix creates a very specific trade-off. JD's model is heavier and structurally lower take rate than pure marketplaces, but it can offer a tighter promise on speed, reliability, and after-sales, especially in electronics and appliances. In first-party, JD's product revenue is huge because it books the full sale price, not just a commission. But the economics are still retail economics. Procurement terms, inventory turns, shrink, returns, and fulfillment costs decide how much profit is left at the end. In third party, the model looks more like a platform. JD earns commissions and service fees and then sells merchants' traffic and conversion through marketing tools. This side is structurally higher margin, and it's one of JD's main levers to lift profitability without depending only on volume growth. And the glue is logistics. JD didn't just build an app, it built a fulfillment system that can move parcels at scale, handle returns, and stay consistent during peak events. That's why JD's brand is tied to reliability and why it historically leaned into same-day, next-day delivery programs for in-stock items. On the revenue chart, the story is scale. JD grows from roughly 181 billion RMB in 2015 to about 1.16 trillion RMB in 2024, driven by heavy 1P retail volume, with services gradually layering on top. As the base becomes massive, growth naturally moderates, but the basket keeps expanding beyond electronics into broader general merchandise and higher service categories. Latest read, 9 months 2025, total net revenues were 956.8 billion RMB, up 17.9% year-on-year. The re-acceleration is largely mix-driven. Services are growing faster and new businesses ramped sharply, including JD Food Delivery, while JD Retail and JD Logistics also stayed positive. The key caveat, which we'll quantify later, is that management frames the 2025 push as investment heavy. Revenue is benefiting from scaling initiatives, but profitability is being pressured by the same cycle. EV to revenue has collapsed from 0.86x in 2021 to 0.21x today, mainly because the share price resets, while sales stayed huge. That's a clear T rating, and it leaves JD looking very cheap on sales versus China e-commerce peers. From here, the right way to read JD isn't just is it growing, it's what kind of growth. If the mix shifts towards services, the company can expand profits even with slower top-line growth. If the mix stays retail heavy while competition forces aggressive pricing, margin expansion becomes harder. Ultimately, what matters isn't revenue scale, it's earnings power. JD has improved EBITDA margin over the decade, but the business remains structurally low margin and highly competitive. So the moment JD leans into subsidies, profitability compresses. In 9M 2025, margin falls back to approximately 2% as growth shifts into instant retail food delivery. JD is often described as an ecosystem, but the logic is practical. Once you have procurement, warehousing, last-mile delivery, payments, and customer service, you can extend into verticals where trust, compliance, and fulfillment matter. JD Health is the clearest example, a health commerce and services platform built around regulated supply, brand trust, and reliable delivery. JD Industrials applies the same playbook to industrial procurement, MRO and B2B supplies, where the price is repeat purchasing, standardization, and procurement efficiency. Then there is on-demand and local retail, where JD's exposure has run through Dada and related initiatives. Strategically, this matters because expectations have shifted toward 1 hour, not next day. But it's also a subsidy-prone battlefield. Dense delivery networks win, and they are expensive to build and defend. Now, we get to the part that tends to matter most in a JD debate: capital allocation outside the core. JD has a long history of launching adjacent initiatives, some strategically coherent, many financially messy. The pattern is usually the same. Core execution is strong, growth gets harder, competition intensifies, and management tries multiple vectors at once. Local retail, discount formats, overseas consumer plays, new verticals, hoping one becomes the next growth engine. That's why new businesses is a discipline test. In 2024, the group is simple to frame. JD Retail generates the bulk of operating profit, JD Logistics is becoming meaningfully profitable, and new businesses is still a drag. In 2024, JD Retail produced about 41.1 billion RMB of operating profit, JD Logistics about 6.3 billion RMB, and new businesses was around minus 2.9 billion RMB. This is also where strategic pressure shows up. When the market stops gifting you share, you either improve monetization inside the core or you go hunting elsewhere, often with lower odds of success. One quick caveat: China e-commerce doesn't have a single official market share table. Definitions vary. So this is an estimate built by triangulating third-party snapshots. With that said, the direction is hard to miss. JD is approximately 23.4% in 2015 versus 16.6% in 2025, a decline of about 6.8 points. The story behind that erosion is fragmentation away from the old two-player area. Pinduoduo takes share on price and factory direct models, while Douyin Kuaishou pull more commerce into content and live shopping, leaving JD fighting harder just to hold its lane. JD's consumer e-commerce attempts in Southeast Asia are a good case study in why diversification is hard. In Thailand and Indonesia, JD ultimately shut down operations as the region became a brutal battlefield dominated by players willing to spend heavily on subsidies, logistics, and marketing. JD's own messaging around the closures pointed to a refocus. Instead of running local consumer platforms, it would emphasize cross-border and supply chain infrastructure. The underlying drivers are consistent with the SEA playbook. High customer acquisition costs, intense price competition, rising delivery expectations, and scale advantages accruing to the leaders. If you're not committing to be top 2, the economics get ugly fast. And that's the broader point. Outside the core, JD has repeatedly shown it can build, but it hasn't consistently shown it can build profitably. With the operating margin picture in place, the next step is to see what actually reaches shareholders. On the EPS chart, the message is volatility. In the mid-2010s, JD was building a heavy 1P plus logistics model, so per share earnings were thin or negative. EPS turns meaningfully positive in 2019, spikes in 2020, a year that includes large non-operating items on top of the underlying business, and flips back to a loss in 2021 as those tailwinds reverse and the environment resets. From 2022 to 2024, you get the cleaner trend investors care about. Execution tightens, the mix improves, JD Logistics stop being a drag, and EPS rebuilds to 13.83 RMB in 2024. Latest read, 9 months 2025, basic EPS is 7.81 RMB, down approximately 25% year-on-year, which fits the story we've been building. Revenue can reaccelerate, helped by new businesses, but that doesn't automatically translate into higher earnings during an investment subsidy cycle. JD's differentiation is operational, and operational advantages usually leave fingerprints in the asset base: warehouses, automation, delivery capacity, and the systems required to run them efficiently at scale. On the asset chart, the message is stark. JD has built a much bigger physical machine per share, especially post-2020. PPE per share rises from about 2.3 RMB in 2015 to roughly 27.7 RMB in 2024, about a 12x increase, reflecting years of warehousing, automation, and fulfillment capacity layered into the model. But the market's willingness to pay a premium for that asset base has compressed sharply. Market cap to tangible equity goes from about 4.6x in 2021 down to approximately 1.34x in 2024, and it's 1.48x today. JD's balance sheet is still net cash. In 2024, it's roughly 108.4 billion RMB cash versus 40.9 billion RMB gross debt, about 67.5 billion RMB net cash. Latest read, Q3 2025, cash approximately 113.1 billion RMB, gross debt approximately 56 billion RMB, so net cash approximately 57.1 billion RMB. Still positive, but lower because the 2025 push is being funded through the liquidity stack and more short-term financing. The natural follow-up is, what is JD actually spending on? Since 2025, JD has been redeploying capital into adjacent bets to defend and extend its model. In China, That includes JD Takeaway in food delivery, multi-billion yuan subsidies for instant retail, and 5 discount superstores. JD is also spending aggressively on courier support, including housing 22 billion RMB over 5 years. Internationally, JD Logistics launched Joy Express in Saudi Arabia. In Europe, JD agreed to acquire C Economy in a 2.2 billion euro deal with tighter regulatory scrutiny. JD also brought Dada fully in-house and is exploring external funding optionality via Jingdong Industrials. Same theme overall. More bets outside the core, and they all compete for cash that used to sit more comfortably on the balance sheet. Now let's switch to the shareholders' lens. Capex, free cash flow, and then how that cash is returned through dividends and buybacks. On Capex, you can see 2 build phases. A ramp into 2017-2018 as JD scaled warehouses and fulfillment capacity, then another investment wave around 2021-2023. By 2024, Capex steps down again and Capex to revenue moves lower, suggesting the infrastructure cycle is no longer accelerating at the same pace. Free cash flow becomes much more meaningful from 2019 onward and peaks in 2024, which is why the stock's today price to free cash flow on the chart is essentially a 2024-based multiple. But 2025 is a different regime. The latest disclosures show free cash flow turning negative again, about minus 10.8 billion RMB for 9M 2025, consistent with an investment subsidy-heavy push where growth is less cash convertible in the near term. On the dividend chart, the story is simple. JD only became a dividend payer recently, and since then, the payout has normalized. 2022 looks like a one-off spike, while 2023-2024 settle into a more sustainable profile, with a yield sitting in the mid-2% range at today's price. On buybacks, the scale is material. JD has a $5 billion repurchase program running for 36 months from September 2024. That annualizes to about $1.7 billion per year, or roughly 3.6% of today's market cap. On the regression chart, you can see that since the Hong Kong listing, the stock has been in a clear downtrend. The key valuation point is the PE. On financial year 2024 earnings, JD is only approximately 7.3x. But that multiple is backward looking. If 2025 earnings are being hit by the subsidy cycle, especially food delivery and instant retail, then a 25% EPS step down mechanically lifts the forward PE to approximately 10x. So where does that leave us? JD is not a clean quality compounder story. It's a value situation with a very specific trade-off. The core franchise is real, a hybrid retail plus marketplace model anchored by a logistics machine that's hard to replicate and still shows up in customer trust and service reliability. That asset base matters because it gives JD a moat that isn't just branding, it's physical density, processes, and execution. But the downside is also clear. Capital allocation outside the core has been inconsistent, and 2025 is the latest example. The food delivery push pulls JD into a subsidy-driven price war that can grow revenue while squeezing earnings and free cash flow. And the track record on new bets hasn't been reassuring. Thailand and Indonesia are reminders that expansion attempts don't automatically turn into profitable growth. My take at today's price is simple. With JD around 16.6% market share in 2025, and with the logistics and fulfillment assets it already owns, I find it unlikely that JD will see another decade of market share erosion of the same magnitude. The more realistic base case is stabilization, not collapse. If that's right, then the stock doesn't need heroic growth to work. It just needs the core to hold, services to keep improving, and management to avoid major mistakes with a still significant cash on the balance sheet. So yes, not a quality investment case, but attractive value as long as capital discipline holds over the next few years. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe and share. And if you want to dig deeper into another company being hit by China's price wars, check out my Q3 2025 results video.